Welcome you to today's webinar. Today we are going to discuss one option strategy and how to do a rollover of that strategy. So before that, we will have a look at the position of Nifty and Bank Nifty in terms of the chart perspective, and then decide what strategy we should adopt. Now we are only giving an illustration right now, and no, we have to look towards doing a mock test of that particular strategy and then implement it with a very limited downside risk. So now first we will go to the market straight away, the chart. Today Nifty closed at 16,887, and one day it had a brilliant rally, that is on Friday it took off well, but only today to almost reverse the gains that was made on Friday. Now the last bottom close is this, that is the 16,818. Luckily today it has not closed below 16,818. It closed at 16,887. So any further break of 16,818 on a close basis will make it bearish. Now also, if you look at the trend line of this one, that is the from these two important this one. So this trend line has to be broken before we can look towards some bottoming out of the market. Now, so that comes to close to 17,350, and it is progressing down to 17,330 and slightly below level. So it has to clearly cut above 17,300 levels before we can think about some sort of a rally which can push the market even much higher. Then probably it can go to a 61.8% retracement of 18,100 to 16,747. So now first it has to clear minimum 17,187, 17,200, and also this particular trend line. Now last week we had mentioned that possibility that it can come closer to 16,650 and rally, but we should put a stop loss above 17,200 for any short position. So that has held intact, so it has not crossed 17,200. So right now we will keep any position, stop loss position at 17,200, because this is the close, up close, which is 17,094. So there has to be a close which is at least above 17,100 before we can say that no, we have looked at some sort of a bottom. So now let's look at the Bank Nifty also, but let's now keep these two levels as important. That is, the close should be, Nifty should close above 17,100. Also we need to be careful right now up to 17,200 to 300 levels. So these are some important levels to watch. So we will take 17,200 because there was one important 17,170 low, and this 17,170 low has to be taken off in a decisive manner. Now it has not gone above that, went up to 17,187 and came back. So this particular level, let's say, has to be cut. So that means we will keep 17,200 now as an important stop loss for any short position. Now where is it likely to head towards that? Let's look at the Fibonacci retracement of this level, which is the 15,190 to we'll remove the volume. I think this is so now we have 16,636, 16,650, and then 16,300. So 16,300. So these are the two important support levels which it can come. So 16,640 to 16,300. So we will keep it that way. So this is the level that probably we may look towards heading towards in case if the bearishness persists. There are many reasons why the bearishness can persist. One is that fundamentally we have the yield, 10-year yield in India now going up to 7.44%. US 10-year yield is also spiking closer to 3.8%. all the central banks are quite aggressive in hiking rates, which does not bode very well for the markets. But only thing is, we have been saying that the Indian markets are outperforming other markets, so probably our extent of fall may not be that much. So we have to look towards 16,300 as the probable target from 16,800, 900 levels, which is another 4% or so. So probably it can get rested closer to 16,300, and we have to see how it behaves from 16,300 levels. So let us now look at what probably then the strategy that we can adopt as far as Nifty is concerned. One is very clear, that since now we are below all the major moving averages, suppose if you look at the 200-day, 100-day moving average, all the moving averages have been cut. Now I can show you that the 100-day moving average came at 17,000, so we will remove this. Look at the moving average. Now the 100-day moving average is the one which gave this last support. See, this is the 100-day moving average. So this was the last important support. It came and then took support here, and now it has to break below that. So let's look at the 200-day and 50-day moving average here. Look at the 50-day moving average. So 50-day moving average is coming closer to 17,430 level. So if all the moving averages to be crossed, 20 also will be coming closer to that. So we are looking at a sort of a bullishness only if all these levels are cut. Okay. So 17,410, 420 levels is where probably right now the the maximum resistance that can come from the moving average point of view. But from the Dow theory, where higher highs and higher lows, 17,200, if it is cut, then probably we will be heading towards 17,400, where there can be cups. If the situation is bullish, it can cut and close above that. Now let's look at the 200-day moving average. The 200-day moving average is whipsawing around the 200-day moving average. That's coming closer to 16,990 levels. Let's look at the 10-day moving average. So today, the 10-day moving average is where it got resisted. That 17,200, 210 levels. That is where the resistance has come now. So that it is below 10-day, below 20-day, below 50-day, now below 200. Only thing it is slightly being above 100-day moving average. So the last bastion for the bull is the 16,750 levels. So if that is cut, then we should be seeing much lower levels to come. So 16,300 is a level which we can earmark as a possible support area that can come. Considering this, what should we do? Now, we have many trading possibilities. One is probably, you can look towards buying a put. You can sell the futures, keep 17,200 as a stop loss. That is one. Third thing is that you can buy a put spread strategy. You can probably look towards a butterfly strategy up to 16,300. So these are all the possibilities that you can look for. So we will now look at the rollover type of strategy in one of this. Now let us look at the spread option. Now before that, we will also look at what happened last week. When we illustrate this, we will tell you what strategy we can probably look towards in for the not on 6, because we have got 1 day trading days not there on Wednesday. So we will look at the next week, that is 13th of October. We look at 13th of October, also the end of this month strategy. Now when you talk about spread option, I think we know about what is a spread. That is, it should have two legs. So in the case of a put spread option, and you are paying it's a debit spread. So let us say now 16,900 approximately. So let us say you are doing 16,900, 16,800 put option, spread option. I'm just giving the illustration. You can place it at 100 points, you can place it at 200 points. but I'm just giving just one example. Okay, how much of spread that we need to keep, we will always look at it at some stage. Now what we are trying to illustrate is that how should we what should we do with a strategy like this. Now for those, there are different types of traders are there. One who doesn't mind putting stop losses, then getting back into trades as we get, so very well psychologically controlled. In that case, I think they become clear winners. But there are a lot of traders where they know about the trading ideas, they know about the know how to view the chart, take positions. But once the loss comes, I think it becomes a demotivating factor, and then once the loss comes to get into a trade again becomes difficult for them. Now, for those traders who don't want to put stop losses, what is the alternative to trade with a very limited downside? Now, let us say you're looking at 16,900 to 16,800 option. We will look at the October 13th option. What is the price difference for 16,900 to 16,800? Now, NSE option side, NSE option chain, we go there. This is for the 13th. What we have illustrated is for the 13th of October, and we can see the 16,900 option at 225. Last traded price 225, and 16,800 is 187 approximately. So around 38 rupees you can say, or 40 rupees. Let us say the difference is approximately 40 rupees. 16,900, 16,800 is 40 rupees. Okay. Now, normally, so in this particular move, what happens if there is an 100-point fall or 100 points rally? We don't need to be a super this one, or look at other parameters of delta, all those things. We just look at the option price itself. We'll give an example. So let us look at what the price is between 16.8 and 16.7 and 17,000 and 16,900. That is, we will go for one leg below and one leg above to know what will happen if there is an 100-point fall or 100-point rally from here. Okay. So let us look at the 17,000, 16,900. 17,000, 16,900 option, that is 280, 280 and 225, right? So it is right, 17,000 is 17,000, sorry. So 17,000 is 280 and 16,900 is 225. So it comes to 55 rupees. Right? So 17,000, 16,900 is 55 and this is 40. So that means if it moves down, then we are likely to get 15 rupees. But I think because last traded prices don't reflect the exact this one for a next week option, I think this difference will not be 15 right now. I think probably the difference could be something like 10 rupees. That is, for every 100-point move, we may get a 10 rupees at this point of time. We are not closer to the expiry, so we may get something very closer to 10 rupees movement. That is, if we shift by down by 10 rupees, that is, if at all we are going to get 16 from 16.9, it's going to fall by under rupees, then whatever that we are talking about, a 40 rupees, this 16,900 to 16,840 can become around 50. Just keep it like that for the time being for understanding, because the last traded prices normally may not have reflected, particularly for 13th, the week after. It might not have been that liquid to give it the right price. So for the time being, let's assuming that is going to be around 10 rupees movement. That is, if 100 rupees goes down, then it probably this can come closer to around something like a 10 rupees difference in the spread option. So similarly, when it goes down as it comes by 10 rupees, when it goes up also, then you will lose 10 rupees. You will lose 10 rupees, and that could be seen between 16.8 and 16.7 right now. 16.8, if you look at it, is 186, and here it is 148. right? 16.7, and this is 186. So there's something wrong in the quotes probably today, because this is also reflecting 38 rupees, and 16.9, this difference 225. Sorry, this is 225 and this is 280, right? So this is 54 rupees. I think. No, sorry, 16.9 is 225 and 16.8 is 186. That is approximately what we said, around 13 plus 25, 38 rupees. So this is 40 rupees we can take, and this is 186 and 148, 16.7, which is also 38 rupees. So it cannot be like that. So there is something wrong in the quote here right now. So we will take this difference also approximately as 10 rupees. So the difference for an 100 rupee movement on either side can be something closer to 10 rupees movement. Okay. So let us say we have paid 40 rupees now for 16.9 to 16.8. So on an average, when you roll it over up, so let us say the market goes up. Okay, the market keeps going up. Now if it is going to go down, no problem, because we are making money. Now let us say if it is going to go up, the problem comes for traders who cannot put stop loss, because right now we are talking about a 17,200 as a stop loss. So what we can do right now is, let us say you buy a 16.9 to 16.8, okay, for 40 rupees. Now we talked about 17.2 as the stop loss, so let us buy a 17.2 17.3 call option. Let us say, what is the price? So right now it could be 20 rupees. It should be 20 rupees, but 17.2 is 94 and this is 67. So it reflects around 27 rupees. So let's say it's 25 rupees. 16.9, 16.8 is 40, and this is let us say it is around 25 rupees. It should not be like this, because there is something wrong in all the codes, but let's keep it like this. Now that means 40 plus 25, 65 rupees you have paid. Okay. Now let us say the market keeps going down or it keeps going up. So there are two alternatives. Let us say it keeps going up, because that is where the loss comes. So 16.9, 16.8, let us say it goes up to 17.2, 17.3. So for 300 rupees, what you would have done is, by doing the rollover, the same spread, when you move it by another 300 rupees in the upside, let us say it goes to 17,000, 17.1 and 17.2. You are cutting this spread, you are cutting this put spread and bringing it to one higher strike spread. That is, if it comes to 17,000, we move our spread to 17,000 to 16,900. 17.1 to 17,000. If it comes to 17,200, we are, if the price comes to 17,200, we will move this to 17,200 to 17,100. Okay. So let's see, we have done like this. Then that means what would have happened is the same 40 rupees. Let us say we have paid 10 rupees, 10 rupees, 10 rupees on average. So 30 rupees would have paid. So 30 plus 25, 55 plus 40, 95. So we would have paid 95 or even 100 rupees. Closer to that. Okay, 95 or whatever it is. So that means now we are getting, when it comes to 17.2, you will have a price like this. It could be 17.2 to 17.1 put spread, and then 17.2 to 17.3 call option, and maybe you would have ended up with some 90 rupees to 95 rupees that time. Okay. Now almost, if it moves down to 17.2, let us say you have moved yourself, it comes to 17.3, and in that case you would have a completely locked in, because you will now roll it to 17.3 to 17.2, and probably you would have got closer to pay the same 100 rupees, which is the gap between the spread. Now this 17.2, 17.3, 17.2, 17.1, let us say you paid 90 or 95 rupees. Then on the close, on the expiry day, it is below 17.1 or above 17.3. Okay. You will not make a loss. You will not make a loss, right? So probably your stop loss issue would have been solved. Your stop loss issue would have been solved. So you keep rolling it over as it climbs higher. Now what you do is, when it comes down, let us say from here it comes down, either you can leave it totally blank, it starts crashing. In case you just leave it blank, you have paid some 65 rupees total for both the call and put. Then if it is below 16.8 by expiry, you still make 35 rupees and leave it. So that is one alternative. Second thing is, what you do is, you want to get this 25 rupees which you have paid on the call option, right? So which you have paid on the call option. So what you do is, at least you want to recover a part of it. So if it starts to move down, then 16.9 to 16.8 which you add, okay, if it moves down to say from 16.9 it moves to 16.8 or so, you bring this to 16.8 to 16.7 and take the profit and keep it with you. You take the profit and keep it. It could be 10 rupees. Okay. For the call option spread, you have paid 25 rupees. So you would have paid 10. You would have taken 10 rupees off. Okay. Then 16.8 to 16.7, it keeps going down. Okay. Probably you just leave it there. You don't need to keep rolling it over there, because now your cost has come from 65 to 55, and if it is going to close below 16.7, you're anyway going to make some profit. So you can just leave the trade like that. So if it starts going down, just keep 1 point roll down, 1 point roll down, and just leave it blank, and leave it blank. So chances that no, you will end up with a good profit will be quite certain in a fast crashing market, right? So this strategy you can look towards doing this in order to ensure that your stop losses are not you are not swayed by your stop losses problem. Okay, so for those who want to overcome the psychology of a stop loss and to keep themselves throughout that expiry period, okay, with just one active strategy, can definitely consider this and do it on a proactive basis. Proactive in the sense, not necessarily on every intraday. If it starts moving up, say let us say we have done this strategy, let's go to the chart. See, last Thursday, I think this Thursday is 6th and 29th, let us say. This is 29th. On 29th, let us say we did this strategy, which is at that time it was 16.8. So you might have done a 16.8 to 16.7, right? So 16.8 to 16.7 you would have done. Now what would have happened is, we might have rolled it over day before on Friday. The same 16.8, 16.7 you would have cut it off and brought it closer to the 17.1 to 17,000. 17.1 to 17,000 we might have brought it. Okay. So 17.1 to 17, at that point of time also, if you want, what you can do is that you can take the profit, because you know that if it is likely to fall, you can take the profit in the call option and put it in the put option also. So what hopefully you're getting this point is, let us say we did this trade on that last week. We entered the trade at 16.8 to 16.7. Okay, and we also did a same call option like what we are talking about, 300 points. So let us say 17.1 to 17.2. So on Friday it closed at 17,094, which means this 17.1 to 17.2 would have given a profit which is at that time, if you have done at 25 rupees or so, this would have come to 50 rupees or so at that time. This would have lost money. So whatever that is lost here, you get it here. You get the profit here. Almost. Okay. So what you then do is, then you roll over this option from 17.1 to 17,000. 17.1 to 17.10, and probably you could have just suppose if it starts still to go up, what to do? So what you could have done is probably another 300, 17.4 to 17.5, you could have done that and left it. So you would have got the same trade. But now you would have put it 17.1 to 17,000 with 17.4 to 75 and paid that 65 rupees still there. Okay, now it has come down significantly. Chances that if it's going to end below 17,000, you can sweep the entire profits much more comfortably. Okay, So that is one way of looking at this the rollover strategy. And what you should do as far as the rollover at any point of time is something which a trader has to have, because it is now, we are now illustrating that. So that means there is a difference between doing this trade on actual basis and an illustration that is being earned right now. Because the speed at which the market moves, your assessment that probably the market can fall from that particular level, from that particular important support resistance levels. Those things will make a lot of difference. So you should understand the overall significance of the trend and the magnitude and whether the trend is changing or so. So these will play a part in taking the profit of the counter option, call option that we did, because we are expecting the market to go down. So that is why we are taking a near money spread option. And to ensure that we are not getting into a problem of a stop loss type of situation, we are putting something which is farther off call option in order to just balance it after 150 points move. So probably the risk there could be some 10 rupees or 5 or 10 rupees is what we are carrying at that point of time. So now this, how you juggle with the strikes is something which you will get through experimentation and through your own knowledge. So I wouldn't do this even through algo, because the algo can probably, if you give a particular system, then it can probably do it mechanically. But at some stage, that when I want to remove only one leg in a situation like this, I will have to think, I will have to employ my own trading call at that point of time and do it. While the algo could be probably useful for executing the trade, but the thought process, all the thought process cannot be packaged and loaded in the algo itself. So that is the beauty of a structure where the trader thinks what should be done, So I would prefer that for execution capability, you can do, probably you have in your system where you can put a spread order, rather than trying to do two individual legs separately. There will be a spread order trade. You can do the spread order trade and come out of the situation a little more easily without any slippage, rather than even doing this through the algo system. So this is one illustration, and we will see how it works, because we have now illustrated a 16.9, 16.8 today at 40 rupees, and 17.2, 17.3 we have done at 25 rupees. So let us see how this works out. 40 plus 25 we have kept it around 65 rupees, and let us see how this particular trade works, this one. So you don't need to cut it off at every 100 points, I would say. Okay, rise. Probably you can look at some 200 points rise or some important levels at which you can do, because every day, at the end of the day, if you see, probably during the course of the day, it might have even gone up by 200 points. But end of the day, you may see that only something, even a flat close or a small difference can happen. So we can just do it at the end of the day. You can just try to do at the end of the day type of strategy, rather than looking at this. Or probably you can look at some very important critical levels at which you can cut the trades and do it. So this will depend on how probably you are looking at the market, and how you are looking at the technicals, what big call that you are going to take. So those things will decide about the profit. But only thing is, I can tell you, there's a very, very low downside risk. I mean, like, probably in this strategy, I feel that chances that you may lose 10 rupees or 15 rupees if you do that judiciously. Okay, so you can just test yourself that capability, because if you, by over a period of time, you are not losing anything and you are gaining only a small amount also, then you can do more contracts to do that. Because if you have gained the experience to do that, you can do more contracts also to do that. Okay, so the same type of strategy, whatever that we thinking about this, we can adopt this, whether it is going to be a call. Now we have talked about a spread of 100 points, so it could be a spread of 200 points. We can do that, or probably you can also look at in a butterfly option also. If you want, you can do the rollover through a butterfly, because we have already illustrated what is a butterfly option and how you should take a butterfly trade. All those things we have highlighted some time before. So if you want, you can do a rollover in butterfly strategy also. You can do the rollover as far as the call and put, plain call and put option also is concerned. We have already illustrated what probably you can do in this particular trade also. So with all these things, no, you at some stage or there, no, you'll know what you should do, because in the case of a plain call, plain put, there is a problem mainly because of the time decay. Mainly because even if you do the rollover, probably no, there is a chance that you can lose on the time decay, and the gain that you still subsequently make will be a little difficult, because the same 16,800 option, let us say last week if you had done, probably you would have paid 160 or 170 rupees, and same thing next day itself when it went up also you might have paid 160, 170, but this particular trade we might have had some loss. But the 17,100, now we will be having a strike closer to 17,100 minus the option premium minus the rollover cost loss that we might have paid. But still that will be a little more still beneficial compared to keeping the option dead at the same level of 16.8 or so, which may or may not prove to be that profitable. But a spread option normally, it eliminates a lot of time decay. So that's the reason why you're saying that you do a spread option and consider a rollover in the case of a spread option, which could be, because the spread option, because it removes the time decay, more or less it will function like a futures. Only thing is that in the future you need multiple contracts of spread option in order to come to one futures. We don't need to do that, so we can just have one or two spread contracts to understand how to do that, and make, even if you make 20 rupees profit, it will make one contract, it could be something like 1,000 rupees per that particular week. So a very slow and steady process of trying to get a understanding of the option, as well as very less downside risk, removing the problem of a stop loss, and making very steady profit. So we can consider that type of option for a rollover. Now we can look at the Bank Nifty option. Bank Nifty, same thing happened as far as Bank Nifty also is concerned. But today the close is still above this particular, because once it started to move, now we have a possibility that probably at 38,247, because it cut this 38,247. So unless we see a close, unless we see again a dip which is below 38,000, because there is 37,943. So unless we see again below 37,900, chances that probably it can also slightly inch itself higher, but probably go towards these particular levels, which is the 39,650 or 680, before it starts to again have a downside trend, because must know that this low is below this low, this low is below this low. So any rally at any point of time can come, see, even like let me draw this line. I will not be surprised if Bank Nifty at some stage rallies back quite smartly back, even up to, let me draw this, 50% to 68% retracement of this level. It can easily get back to 39,560 to 40,080. So we can have Bank Nifty a possibility going right up to 40,080 also, or at least cross 39,565 to 40,080, because it has come down very significantly. And on Friday we had a big rally, and on Friday we had a big rally, and we are not very sure whether today's fall is just an inside day formation. It's an inside day formation after a big rally on Friday. So there is a decent chance that there can be a bounce back as far as Bank Nifty is concerned, targeting 39,560 to 40,080. So you can position yourself with today's S&P also slightly on the upside of 1.55%. So we could probably look towards some sort of a possibility of a rally as far as Bank Nifty is concerned. So let us place ourselves maybe for a rally up to 39,560 to 40,080. So right now we are at 38,029. So we can look at 38,500 call option for the week after. For the week after, 38,500, 13th October. Bank Nifty. So 38,000 is 710, 38,500 is 467, 467, and 39,000 is 277, 39,500 is 154. So what we can look towards is 38,500 to 39,500 option we can look at. So in case of Bank Nifty, 38,500, 39,500. Call option strategy. Okay, let's look at the premium. 460 for 38,475. 475 and 155. So 320. 320 rupees. Either we can take a straight away risk, okay, of 320 rupees and ride the trade. Alternately, applying the same logic of what we discussed till now, what is the low till now? It is 37,400. Okay, so let us look at 37,500 to 37,000. 37,500 to 37,000. Let us look at the put difference right now. This is for 495 and this is 314. 495 minus 315, right? So 180. So 320 plus 180 is 500. So assuming that you do this trade, okay, assuming you do this trade and market goes up, then definitely you will have a profit which can come undoubtedly. You can get a good profit. Now, if it is going to sink, that is, it has to go below 37,000, right? So that is the last important low that we got right now. This low is 37,385. 37,385. So we have put at 37,500 to 37,000, or you can look at 37,000 to 36,500. So we are just keeping 37,500 to 37,000 itself, because right now we are at closer to the 37,860 level. So if it is going to cut this, and then we leave this entire thing open, we will not just do any rollover. Probably we can just bring this from 39,500 to 39,000 or so. So right now we are going to get something like 180 plus 320, 500 rupees. So if this is going to sink completely below this, then in that case we will not lose anything. We are protected, okay, of the capital. If it is going to rise, then we will definitely make some profit out of this deal. So we can consider this type of strategy also, without doing a rollover. Without doing a rollover, as far as Bank Nifty is concerned, considering that there is a potential to go right up to 39,500 because it has fallen quite heavily. So there is a chance of a pullback which can take it to 39,500 to even 40,000 levels. 40,000 levels. A 2,000 points a sharp rally of 5% cannot be completely ruled out as far as Bank Nifty is concerned. And we are talking about around 38,000. 39,500 is 1,500 points, a 3 to 4% rally, which means 2-3% rally in as far as Nifty is concerned. It's completely not ruled out. So you may consider such a type of strategy here, and where you are passive also. You are not proactive. Unlike this type of Nifty strategy which we suggested, which is a proactive strategy. If we are considered ourselves from 16.9 to 16.8, 17.2 to 17.3. So let's look at, suppose if it market goes up, then the rollover that we do as far as the option put option is concerned, we can do that. And then if it is going to cut between 17.2 and 17.3, then in that case we may not have any loss at that point of time. We can also consider probably quitting the put option also, and just keep rolling over the call option, or probably take the profit as far as call option is concerned. So that way, by dynamically doing this trade between the call and the put, in many ways, till such time the expiry comes, and after the expiry again rolling it over, because considering that we are not losing any time decay because of the spread option, we can continue to do this trade, roll over the trade, because the chances of loss is going to be quite limited when you do the rollover, because you are going to bring it closer to one of the strikes above which the market is going to expire. Considering that, with a small loss, if at all it happens, we can look towards rolling it over for a different period, and then look towards making some money there in that expiry. So this is how we should look towards doing this trade. For those, this is nothing but an art. I mean, we just gave you some illustration. So if you have a very focused idea of how to make this type of rolling over of option workable, you can think about it, and definitely this will give a very sizable, very fruitful prospect, without getting worried about the market direction too much. Because now today you can see some S&P going up, so tomorrow who knows, market can start up just about firing above 17,000. Okay, so today it went down, tomorrow it can go up. So these things, if you do a directional trade, a complete directional trade, then in that case, you will have the whipsaws on either side. Your long also will get stopped, short also will get stopped, overnight position you can't carry, and most of the time after a gap up or gap down, doing intraday, it just as a small range, you are unable to do anything. So these issues will come. To overcome this is the suggestion that we are given, and we will look at the same thing next week of what happened in this particular week. Okay, so now time is 7:42. You can ask your questions. Thank you very much. So thanks for your participation, and happy Puja holidays. See you again.